When it comes to public companies, Coke is as famous as they get. But do I think it is a solid investment? This is the question that I, Bobby the Market Watcher, will answer in this video. I'll examine their latest results and most valuable information, and of course, at the end, I'll make a step-by-step fundamental analysis of KO stock. As always set with educational purposes and is not meant to be taken as financial advice. Before we discuss Coca-Cola in detail, it is important to understand their industry and the company's dominance. As you know, Coke is a leader in the soft market space, as they own dozens of different beverage brands. But what really amazed me is that even over the last 1 to 2 decades, their market share is slowly rising over time, as seen on the provided chart via Statista. In 2004, their market share was 42%, and in late 2021 it was 46.3%. It is extremely hard to increase your share of a market when you're such an established company for over a century, but Coke manages to do it. According to Global Newswire, the soft drinks market is expected to grow by 5.2% on an annual basis until 2030. Over the next decade, the North American region is expected to grow by 4%, and it is the largest region of sales with a 35% dominance. But the Asia-Pacific region will grow the fastest on an annual basis with an increase of 6.2% annually. Over the last quarter, in Q3, Coke reported their earnings per share are up by 14% on an annual basis, and their revenue is up by 16%. This growth is quite impressive, especially in the eyes of much lower growth stemming from the technology sector. In times of stagflation or inflation, tech businesses tend to do quite badly as they require low interest rates and they have high capital investments stemming from a robust ecosystem. When we have inflation or stagflation, usually the monetary system is not loose, it is tight. This means capital is less easily available and people invest in safer and much more proven businesses. Coca-Cola has a very inflation-hedged model, as when prices of food and beverages goes up, they just increase their prices and that extra cost is pushed back to the consumers. This protects the real earnings of Coke and other businesses in the so-called consumer staples space. This is a reason why Buffett really likes Coke, and it is a 7.5% of his total portfolio. When it comes to business fundamentals, a thing that I really liked before, but now I have some questions on about Coke, is the fact that for a long time Coke was buying back its own shares. These share buybacks from the period of 2012 until 2019 were increasing the company's earnings per share as the income was being distributed to lesser and lesser amounts of shares. But my question is, why the company started to increase their shares outstanding from 2019 forward? This is not ideal as it dilutes current shareholders. A thing that I love about Coca-Cola is their incredible business moat. No matter if the world is in a war, economic hardship, or it has other problems, consumers will keep buying the company's products, as most of them are an essential part of their lives. This massive competitive advantage gives me quite the certainty that the business will be here in the next decade to come. Also a supporting fact is their ever-increasing market share. A fact which now I do not like about the company is that they are historically overvalued in terms of their earnings multiple. The current price to earnings of KO stock is 24.7. For example, 10-12 years ago, Coke was selling at 9 to 10 times earnings. Also, in the past, the company was trading at low double-digit multiples or around the S&P 500 average norm of about 15 to 16. The current high multiple to me is seen as a market risk. Also, it diminishes high future returns. Coca-Cola is also paying a dividend, which is very good in today's market environment. The current dividend yield is 2.85%, which comes to a dividend payout ratio of 0.68, which means that the earnings of Coke in relation to their paid dividends comes out to 68%. This is an okayish level. Preferably, this should be around 50 to 60% or even below, but above 80% is a bit disturbing. The lower this ratio is, the higher the likelihood that the company will increase their dividends and at least not cut them if earnings fall somehow. Buffett really likes KO stock, not only because of their big moat, but also he really likes the simplicity of the business as well as their high efficiency levels. For example, the return of invested capital is 14.2%, which is very good, while the return on equity is incredible and it stands at 49%. This could be somewhat misleading though, as the very high return on equity is due to quite low equity levels, and the equity is low for Coca-Cola because they have a lot of liabilities in comparison with their assets. The total assets are $92 billion, while the liabilities are $68 billion. Their long-term equity ratio is also 1.75, which is too high. It needs to be below 1 and preferably it should be below 0.5. This indicates to me that the company does not have an ideal debt management strategy, and I see high debt levels as an extra risk. In general, Coke has awesome efficiency, very high moat, but the company's price is just too high from a historical perspective to me as a value investor. Also, the debt management is not good enough for me as well. It is also important to note that in stagflationary times, businesses like Coca-Cola in the consumer staples sector perform quite well, due to the unwillingness from consumers to cut back their spending on these companies' products. Also, dividend-paying companies are looked well upon in such economic times. Comment down below, do you want me to analyze other stocks from this space, such as Procter & Gamble, Pepsi, Unilever and others? For now, KO stock is a pass for me and I'll wait for lower prices. Hit the notification bell if you want more of this content, and please make sure to subscribe and comment down below which other topics you want me to cover here next on the channel. Goodbye for now and until next time.